Hello, and welcome to today's episode of the Daily Blend. I'm your host, AC, and we are joined in studio today by Alex LaBrunerie, who is the CEO and president of LaBrunerie Financial. How are you, Alex?
Wonderful. Thank you. Good morning.
Good morning. It is good to have you back.
Thank you. It's great to be back.
Always good to see you. So, Alex, we hear a lot about the S&P.
Yes.
Some of us may have no idea what the S&P actually is.
That's a good question, AC. It stands for the Standard & Poor's 500, which oftentimes when you hear on the radio or read or see something on a news feed that says the market's up today or it's down, it's most likely referring to the Standard & Poor's 500, or the Dow Jones Industrial Average. And what that is are the 500 largest stocks in our stock market, and oftentimes the biggest employers in our country, and kind of a proxy for the market.
Okay, so that's the 500 largest.
Yeah.
Okay.
And there's different types of indexes, but this is the one that is the largest. Includes Apple and Google and many of the largest names, or other types of indexes. But when we often say the market, the stock market, it's the S&P 500.
Okay. And so why is that such an important and reliable? Why is it so important and reliable?
Because there's a firm called Standard & Poor's that's a research firm that's kept the data on the performance of the Standard & Poor's 500 since 1926. So it goes way back. Almost 100 years. So it's really respected because of that. Also, it's important that those 500 stocks change based on their size and growth rates. So that the S&P 500 in 1926 was much different than it was today, and ditto 20 years ago. So they're constantly changing that.
Okay. So we've heard these days lots of comparisons to 1929 for some reason.
Yes, and that's because the Standard & Poor's 500 and other indexes are at record highs. And there's a new book that happens to be written by an Andrew Sorkin, who is an admired financial reporter who also wrote Too Big to Fail back in 2008. And since the market is at these record highs, and the country, sometimes investors want to take a pause. Well, is this a safe place, or should we get out? And I think when a major financial reporter like Sorkin writes a book that's a narrative history, then it gets promoted in the media, and people enjoy reading it. And so comparisons of the great crash of 1929 get made. Hopefully we're not in a 1929 period yet. Each stock market crash is different. I think we're in an old-fashioned American stock boom now. So that's being driven by artificial intelligence and robotics. And our country, AC, capitalizes new emerging technologies with a boom. There's just real money getting invested in. 5 or 10 years from now, I don't think anyone will say that artificial intelligence and robotics will change how we do business, how we see a doctor, how we communicate with each other, on down the line. So we're going through a major industrial boom here. And that's driving the S&P 500 up.
So you think, in your opinion, not necessarily the same thing we saw?
No.
Okay.
No.
But
never guaranteed,
never
right?
Guaranteed,
That's
of course.
Always like everything.
Are no guarantees.
In 1929, there were, I think from bottom to top, the market was off 90%. The Dow Jones Industrial Average and the S&P. So a much different era.
Okay.
But 2008 was something that many of us lived through, I guess most of us who are adults, and that was very tough. That was almost a 50% decline. So in modern era, it can go down big time.
Yes. So how do these cycles repeat and rhyme over?
That it's the business cycle. Something we get, like we're in the boom, we're in a boom now, so there's massive investment, and some might say overinvestment in artificial intelligence that eventually gives way to a really excessive overinvestment, which hits the bubble phase, and then the inevitable bust comes, and that's when the market drops, politely using the word drops. And then from that, the winners, the companies that are the winners, emerge. And we saw this almost 30 years ago with the internet. And towards the end of the boom and the bubble, there was companies that were pretty sketchy as far as earnings growth or profitability, virtually no profitability. But today we live in the world shaped by the internet capitalization of the 1990s. Microsoft, Google, Cisco, on and on.
Yeah. So what's your final advice to us in this
and we
time,
talk
Alex?
this again. See, I think it's making sure you're investing for the long run. If you're in the income mode and retired, make sure you check your risk because you don't want to withdraw money in a down market.
Yeah. Okay. All right. And we can find you, Alex,
at LaBrunerie.com or here in Columbia, 573-449-5313.
Okay, that's where you can find Alex, and Alex can sit with you and give you all this wonderful advice as your financial advisor. Alex, always good to talk to you.
Great to see you.
Thank you so much for joining us, and we will see you the next time you are sitting on this couch.
Yes.
Thank you.
Bye-bye.
This is your Be Well Moment by Burrell Behavioral Health. Life is full of moments of hardships, joy, and everything in between. While we don't always feel joyful, we can think of memories where we have felt joy in the past to create ease now. For this practice, try closing your eyes if that's safe. Think about a time when you genuinely smiled or laughed. Maybe it was a silly moment with a pet or a joke with a friend. Recall the details. Where were you? Who was with you? What did it feel like? We can revisit our moments of joy.